Today, for the Series 6 exam, we are covering one of the most fundamental suitability topics: the main types of mutual funds categorized by their investment objective. Understanding this is not just about memorizing definitions, it's about matching the right product to the right investor, which is the core of many questions you will face. We will focus on 4 key types: growth funds, income funds, balanced funds, and money market funds. Let's start with growth funds. The single primary objective here is capital appreciation. These funds invest in stocks of companies that are expected to grow faster than the overall market. Think of technology or biotechnology sectors. The fund manager is not concerned with generating dividends or current income for the investor. Therefore, these funds are best suited for investors with a long time horizon, like a younger person saving for retirement decades away. They can afford to take on the higher risk and volatility associated with growth stocks in exchange for the potential of significant long-term gains. An exam question might describe a 28-year-old client with a high risk tolerance and a goal of accumulating wealth for retirement in 35 years. A growth fund, or even an aggressive growth fund, would be the most suitable recommendation. The trap here is recommending a growth fund to someone who is retired or needs immediate income, as the volatility and lack of dividends would be entirely inappropriate for their needs. Next, we have income funds. As the name implies, their primary objective is to provide a steady stream of current income to investors. They achieve this by investing in securities that pay regular dividends or interest, such as corporate bonds, government bonds, and dividend-paying stocks. These funds are ideal for investors who need their investments to supplement their earnings, like retirees. An exam question could feature a 70-year-old widow who needs to generate monthly cash flow from her investment portfolio to cover living expenses. An income fund is the clear choice. A common mistake is to confuse income with safety. While generally less volatile than growth funds, income funds, particularly those invested in high-yield bonds, still carry interest rate risk and credit risk. Don't assume an income fund has zero risk of principal loss. What if an investor wants a bit of both growth and income? That's where balanced funds come in. These funds maintain a diversified portfolio of both stocks for growth and bonds for income. The allocation is typically a specified mix, such as 60% stocks and 40% bonds. This approach offers a middle-of-the-road strategy, providing potential for capital appreciation while also generating some income and being less volatile than a pure stock fund. A balanced fund is often suitable for an investor with a moderate risk tolerance and a medium-term goal, perhaps someone in their late 40s saving for college or a retirement that's 10 to 15 years away. On the exam, look for keywords like moderate, appreciation in income, or conservative growth. The trap is thinking a balanced fund is perfect for everyone. It's a compromise that won't maximize growth or income, but rather blend them. Finally, there are money market funds. Their objectives are capital preservation and high liquidity. These are not long-term investment vehicles. They invest in short-term, high-quality debt instruments like commercial paper and treasury bills. The goal is to maintain a stable $1 net asset value per share. These funds are a suitable place for an investor's emergency savings or for money they plan to use for a major purchase in the very near future, like a down payment on a house in 6 months. The Series 6 exam will test your knowledge that while they are considered very safe, they are not risk-free. Unlike a savings account, they are not FDIC insured, and it is possible, though rare, for them to lose value. To keep these straight, remember this simple phrase from matching funds to goals. You grow your money for the future, you take income for today, you balance for a bit of both, and you park your money for a rainy day. This mental shortcut directly links each fund type to its primary purpose, which is exactly how you'll need to think to answer suitability questions correctly on your exam.